Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. But of course, you know that, and that is why you're here. And if you want to listen to this episode, it's probably because you've read the title that says something about investing in an SMSF. And that's exactly what I talk about today with Jeremy Iannuzzelli, who is our resident property and tax expert, or property tax expert and accounting expert. So we dig into all kinds of stuff. We have a little chat about the start about inflation and the impact of that and what opportunities are out there. But more specifically, we dig into investing in an SMSF, when, how, why, what to look out for, all of that kind of stuff. So probably a lot of questions you've been asking yourself too. So if you've ever thought about investing in a self-managed super fund, if you've wondered about it, if you've thought, I've heard of it, but I don't know what it is, then this is an episode for you. So if you think this episode is valuable, or if you think this could help someone just like you, then make sure you share that with a friend, family member, or loved one. Of course, make sure you like, rate, review, and on all of the platforms. And if you've got any questions or topics you'd like us to cover, send us an email to til@dashdot.com.au. All of that being said, let's get stuck right into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is Jeremy Iannuzzelli, and we're going to be talking about all things investing in self-managed super funds. But before we get to that, Jeremy, how are you?
Mate, very well. Heading into a closing down of a 30 June 22 financial year, ready to start the new one as well.
Yeah, totally. Must be busy time for you guys.
It is, mate. Wrapping all the loose ends up, a little bit of planning with clients, planning for our own business, and looking forward to a really good 30 June 2023.
Yeah, totally. I think it's going to be, I personally think we're going to be in a really good financial year in 2023. I think it's going to be interesting. There's obviously a lot going on in the economy. There's a lot going on in interest rates. There's a lot going on in the minds of investors. There's a lot going on for businesses. There's a lot happening at the moment. Tell me, before we start talking about SMSFs, I'd love to just get your take on it from you've obviously got a unique perspective on the market, both as an accountant, an investor, someone who deals with thousands of property investors, all that kind of stuff. You've been through a couple of cycles. What's your take on the current environment, with interest rates rising and all of that kind of stuff? What's your worldview on that?
Yeah, we've just obviously had a quite a large jump, a 0.5% increase, which is the biggest increase in 22 years. But I think we've got to capture that in context. Yes, it is the biggest increase in 22 years, but our rates are still at present being 0.85%, which is historically probably still very low in the last 50, 60, 70, 80 years.
It's not even 1%. The cash rate is not even at 1%. I remember not that long ago when the cash rate dropped below 1% for the first time, and everyone was having a meltdown because they were like, oh my God, the cash rate's gone below 1%.
Yeah, and we're still below where we were pre-pandemic levels.
Yeah.
So there's still a lot of room there for people still to capitalize, and then, potentially room there for interest rates to go up. But, in the long term, interest rates will settle, and they will settle to make sure that target inflation is between 2 to 3%. And people need to price in that interest rates probably will get to 2 to 3% in the long term. And that's where, economics has proven to find its equilibrium. For me personally, I see it maybe as a little bit of an opportunity for people's fear, or capitalizing on people's fear, which is a terrible thing to do, very opportunistic, but nevertheless, as investors, that's what we look for. And what I do feel is that obviously with inflation of cost of living, inflation of commodities, inflation of rents, all the staple items that we need to live, our wages will increase. There's no doubt about it. And, within our client base, we've got quite a large amount of clients that we do see. It's not uncommon now for me to hear my clients saying they're jumping around between jobs and getting a $50,000 plus pay rise.
Yeah.
Now, what that does do is it compensates for the level of increasing costs. It's not going to be around forever. We're not going to be paying $2.50, $3 of fuel forever. It will come down as the supply meets its demand, and many other things will be the same. They're talking about lettuces, iceberg lettuce being $12 for a lettuce. Now, again, weather, a couple other things in there, but not going to be around forever. Lettuce will continue to grow, and it's just a matter of matching that supply with the demand. So it's about capitalizing and going back to the old theory of investing that Warren Buffett and so many people use his quote, get in when others get out and get out when others getting in. This is a great time for me to get in. And Did it back in 2009, post GFC. People didn't want to touch investing, and I jumped in with both feet. I did it back in 1819 when people were fearful about negative gearing under a Labor government. And it looks like, again, I'll be doing it in 22, 23 with, people's fear in interest rates. So as long as you're making sure that the bottom line's being met, we're in a long-term game here. And I can guarantee you that, over the long term, the cost to replace these assets is only going to increase substantially. So that means that the value of these assets will increase.
Yeah, totally.
As we all start to go through the economic cycle for the years to come. So opportunities around the corner. People with some good borrowing power, this is an opportunity to pick up, something at a bit of a discount, but making sure that you maintain your bottom line on your investments.
Totally. I think it's pretty interesting because, as you've kind of pointed out there, obviously inflation's not going to last forever, right? And interest rate rises aren't going to last forever. In fact, I had to look back over, the last sort of 30 years of interest rate rate. There's been periods where they've gone up 2-3% or whatever in pretty short periods of time, but they only ever tend to go up for about 2 years max, and then they come down max. Sometimes even shorter. So that kind of like transitory period that you're talking about is I think pretty accurate of what's likely to happen in the market as well. But they're already talking about signs of peak inflation having passed. There's already signs that computer chip processing chip prices have come down. Spot prices for shipping containers have started to come down. Now they're leading indicators. They were the leading indicators that were going into inflation, right? And so that could be a leading indication that kind of stuff is going to tail out as well. So, and I think you're right. At the end of the day, the fundamentals that are driving the property market aren't really changing. And as long as you're investing well and making sure that, as you said, you're meeting the bottom line, buying properties that have got the right level of yield to make sure you're meeting the bottom line, that you're not putting yourself underwater, all of that kind of stuff, then going against the tide of consumer sentiment is where the opportunity lies. And I think that
100%. And people also got to factor in that if there are potential wage increases to come into the market, and I know employers are willing to pay for good people, productivity, then you'll find that cost of living matches the increase in income that you are receiving. It's just getting through that short-term period.
Totally. The other side of things as well is rents are rising faster than they've ever risen before, right? So they've risen by 10 to 20% in most areas over the last year.
And I'm hearing that across the board, but I'm also telling people at the same time, and we'll use Queensland as a great example because I've been through the various rent cycles there, and New South Wales, but we'll look at Queensland. It's been compressed from a rental point of view for the last 6 or 7 years. Myself included, and many clients haven't been able to lift rent for that period of time. So what we're seeing is a compression, and then now a release of that compression where rents are starting to move. And it's not uncommon that I'm seeing people, as a tenant leaves, a new tenant coming on board with an additional $80 to $100 a week rent. That's an extra $4 to $5 grand a year. And it's happening in Sydney, and it's driven purely again by supply and demand. We've got to go back to the fundamentals of economics. When there's high supply, low demand, we get a decrease in price, and the opposite increases. What I'm also trying to explain to people as well is that as our costs are increasing, costs for construction, labor, trade, and all those other things, people won't be rushing into building new properties. So that means that you'll find there'll be a huge amount of demand for the existing properties to be letted out. And therefore, finally, New South Wales, and it is starting to see an increase in rental returns. And it has to happen because our average yields at the moment, we'll talk about here in Sydney, not uncommon to see an average gross yield of anywhere between 2 to 3%. Now, historically speaking, that's quite low, considering rates will always balance back out at hopefully anywhere between 4 to 5%. So what we'll see is rents increase, which therefore will increase that gross yield. We may see a bit of a correction depending on how much that is on the top line of the purchase price, which means that our gross yield increases again, and therefore the cycle starts. So it is a big circle, and people need to recognize that it's a big circle, and it hits the top, it hits the bottom, and then comes back to the top again and continues to move in an upward spiraling adjustment.
Yeah, couldn't agree more. So that's a great segue then because we're thinking now about the future. We're saying, okay, it continues to spiral off into the distance in an upward trending cycle. So as people are thinking about the future, a lot of people are, some people are thinking, what do I do with my super? Should I put that into an SMSF? Some people who are active investors outside their SMSF are going, great, I'm buying properties outside of super, but I've got all this money. Can I save it there? Particularly at the moment, the share market is not performing particularly well. So when a lot of people have got their money invested in super funds that could be getting invested in shares, they might not be seeing the returns they want there. And they're thinking about potentially, should I be investing in my super into investment properties? And I'd love to kind of dig into that too as well. And I know that there's some stuff you can and can't talk about. It's when it comes to this topic. But what are the basics? When should someone be thinking about, when does it make sense to invest in an SMSF?
Again, it's based upon their personal goals and objectives, their financial incentives for themselves and their retirement. But I can go back and we'll talk about history. Now, I look at our firm, and we manage, quite a large number of self-managed super funds. We manage quite a large number of clients who invest in property in self-managed super funds. And I look at when the times of when we've established a large portion of SMSFs, they were at times similar to this.
Interesting.
So in 2009-10, post-GFC, people couldn't get borrowing their own names. They saw a great opportunity to invest in property. So we saw a lot of establishments of SMSFs. And people then bought property in 2009 and saw their balance in a self-managed super fund double in that period of time when things were quite flat. I look in 2018-19 when APRA came in and really crunched lending. People saw a self-managed super fund as another avenue to gain borrowing and buy property. And again, if they bought in 2018-19 in pretty much any state of the country, they've almost would have doubled their property price. So in essence, sometimes they're getting a compounding return of 200 or 300% on the initial capital that they injected into the self-managed super fund to purchase a property. So that's the timing of the events. It's when people have found it a bit tough to get and obtain borrowing, they want to continue their investment journey. The SMSF levers open that up to them to do it. And then from there, with the right purchases, I've seen some really, really great returns. Couple things to think about for obviously many people is the tax incentives involved around super. That's in super in general. To have an entity where it's taxed at 15% on earnings and contributions, it's just amazing.
Yeah.
The government's opened that up so we don't have a reliance on the pension system to support the retirement of our older population. It's so you can support yourself. So with a 15% tax rate, wow. You're coming to become one of the lowest tax rates across the developed countries. And then if you are investing in super, and whether that is an investment into property or an investment into shares or other things that you can invest in legally in super, if you hold it for longer than 12 months, you get a 1/3 discount. Now, what a 1/3 discount means, accompanied by a 15% tax rate, is you're paying tax at 10% on the top line of the gain. So if you make $100,000 as a capital gain from, say, selling a property, that means the tax on that 100 grand is only 10%, 10,000.
Crikey.
So what people also need to understand is, while super's locked away for the date of our retirement, a lot of my wealthier clients actively try to find ways to build up their super via non-concessional contributions or concessional, meaning deductible or non-deductible, and they actively want to try to grow as much wealth as they can because it's like a treadmill.
Yeah.
You're getting better bang for your buck in the long term having investments deriving income in super than you are in your own name. And why? Two things. Obviously, the lower tax rate being number one. And two, if you go into pension phase, i.e. retirement phase, and you're under the $1.6 million cap at that time. Now, that's as of the legislation today. That may change in the many years to come.
Yeah.
But if you are under that $1.6 million cap, if you've got a portfolio worth 1.5 mil returning 10% at 150,000 a year gross, take away some expenses, whatever it may be, you might be getting 120 grand net with no tax on it at the day of retirement. So it just makes sense for people to actively try to grow their superannuation balance via self-manage or via industry fund in their chosen asset class. And it's a second to none in terms of tax incentive.
Yeah, that's awesome. So can we take a little step back though and go what actually is an SMSF? Like, what actually is a self-managed super fund versus a normal super fund? Like, what's the
start with the basics?
Let's start with the basics, because some people might be listening to this going, "Hang on a second, Jeremy's telling me I only pay 10% tax." Like, yeah, what? Yeah, let's go. Right, but actually, what actually is an SMSF, and how do people go about setting one up? Or what's kind of the basic stuff?
Self-managed super fund, Goose. It's an entity which you establish, and essentially. Yep. It's outside the realms of the industry funds, your Hesters, your C-buses, your Colonials, your Aware Super, and it's an entity which you control. You're the one making the financial decisions. You're the one cherry-picking the investments, rather than going into a pool of thousands of people and you've got advisors on the other side which are trying to allocate where they want to put that money, and it's kind of a best fit for all. you're choosing a best fit for one or a best fit for that entity. So that's the basics of a self-managed super fund. You're in control of your financial destiny. You're paying the bills. You're choosing the asset class. You're picking the investments. You're dealing with the advisors. You're dealing with the accountants, and you're responsible for 100% of the compliance and investment decisions. So that's the basics of it. Depending on how you want to invest in super, it dictates the type of structure that myself or a financial planner or a solicitor can do for you. Because if you are looking to invest just purely the capital, that's a certain structure. If you are looking to obtain funding via the limited recourse borrowing arrangement, and what limited recourse borrowing arrangement is, it's a very strict way of the way banks can lend money to an asset in super. And it was developed as part of an installment warrant many years ago, typically brought upon by the T2 split when Telstra and Telecom changed. It was kind of a precedent that was brought in, and that's where people use that precedent to then obtain funding. And the banks caught on and said, wow, this is a great way to open up another channel and avenue to allow people to borrow. But that, if you're looking at a limited recourse borrowing arrangement, then there's a certain structure that the banks want to see with a custodian and a bear trust, or otherwise known as a custodian trust. So you need to make sure you're talking to the right professionals to ensure they're setting you up with the right structure to do that. Because you'll find that many banks will not lend money to you without that structure being in place.
Okay, I want to come back to the borrowing bit there, right? Because we've gone quite technically. I want to come back to the borrowing piece because you mentioned something earlier. But before we get there, one of the things to kind of tackle, right, is when people say, so you've got, right, so everyone's got a super fund, right? If you're working, you've got a super fund. Now, your choices are, do I put my money with somebody else and they've got a whole team of experts who go and invest that capital and, I get whatever the outcome is, or do I effectively take on that responsibility myself and self-manage that outcome? Do you need any kind of expertise to do that? Like, is there anything that says like, what if you've got no experience investing? Like, is there any, like, how do people kind of tackle that? And is there kind of a minimum requirement, for it to even make sense? Like, if I've got $5,000 in super, would that make sense to do it in SMSF, or, how do you think about that?
So the minimum requirement from ASIC's point of view is anywhere between that 200 to 250 mark. Ideally, the more in super that we have, the better choice of asset we can obtain. Anything below that, you really need to make sure that fundamentally the asset that you're seeking matches the capital requirement that you have. If your goal's out there to go buy $100,000 investment property, well, then obviously you'll need a lot less in super to do that. But you've got to obviously maintain the quality and then factor in, well, was that the right investment decision for what I'm wanting to achieve? So like anything in life, more money we have, more doors we can open. I like to see minimum 250. Nevertheless, we've, as per advisory from the clients and financial planners, they've established it with a little bit less because there's been a certain strategy that they wanted to obtain. So, we do ensure that people have a number of different professionals that they can chat to prior to making this large financial decision, which then reverts back to the second part of your question is, well, do you need to have a strong investment background to make it work? The answer is it helps, no doubt about it. The more savvy you are, the more knowledge you have about investing, obviously, the better type of asset one can purchase. But there are professionals that you can have. There's buyer's agents, which, you do quite a bit of investing, obviously, for many clients around Australia. There's financial planners, accountants. There's an array of professionals that you can engage to help you make the right decision. Now, without people knowing it, in most circumstances, they're paying for those professionals already via the industry fund. It's just that they don't see it. They're not the one paying the bills. Without looking at your statements every quarter, half year, or year, you're not seeing where the admin fees are, which go towards obviously the planners that the big super funds use.
Yeah, makes sense. Okay, so you mentioned earlier that you've seen a lot of SMSFs get set up and get utilized and all of that kind of stuff when in times when people have had, reached kind of maybe roadblocks or whatever in personal borrowing. So, and you started to talk about borrowing there a little bit, limited recourse borrowing and all this kind of stuff. How is investing in an SMSF different to investing on your own? Does it factor in your own income? Is it treated completely separately? Or why is it that if somebody has maybe hit a roadblock in their own personal investing, that they might be able to invest in an SMSF?
Well, I won't dive too much into the broker specialty, but
fair enough. Yeah.
From personal experience, it's not taken on the back of your own personal borrowing capacity.
Yeah.
The self-managed super fund itself has its own personal borrowing capacity. That capacity consists of obviously the investment that you're buying and the income attached to that investment, and the amount of contributions that you make into the self-managed super fund. So ultimately speaking, the higher income that you earn, the more statutory amount of super that goes in. So therefore, yes, your borrowing capacity will be a bit higher than someone on a 50,000 salary compared to a 100,000 salary.
Yep.
At the same time, if you can make additional contributions and show a history of making additional contributions, then that will also be factored in to the borrowing capacity of the super fund. So the bank's ideally wanting to see that, if we give you a loan for 25 years for your super fund, is the investment income in combination with the contributions enough to pay down that debt over that many years? And if the answer is yes, then that's when the door opens to obviously buying with inside a superannuation structure.
That's really interesting, right? Because a lot of people probably aren't thinking about it like that. Their super contributions are in fact an income stream. So you've got your SMSF, which is set up effectively. Easiest way to think about it is it's its own business, right? So it's like, right, so you've got this business that is your self-managed super fund, and then you've got the superannuation contributions which come from your employer. That is a revenue stream or an income stream for that company, that business that you've got set up. And then if it was to go and buy any other assets and go in there, any other income that those assets would generate would also be an income stream for that business, right? So it's kind of like a standalone, independent kind of thing. So that naturally lends itself to the idea that in order to maximize your opportunity in a SMSF, you probably want to go for higher income producing assets would probably make the most amount of sense, right?
The answer is yes, and no. You do want to have an asset which produces the best level of return you possibly can get.
Yeah.
But at the same time, you do want to have a combination of growth. So an industry fund will have its assets in shares, which return and capital, and also the growth as well. If you can find an asset where there is good growth, then ideally that's fantastic in combination with rental return. You don't want to just have an asset that has all capital growth and potentially no rental return, because if you want to keep that asset, you need to be able to facilitate holding that asset. And then when you do retire, you want to obviously live off the cash flow that it provides.
Yeah.
At the same time, to really rapidly grow your asset base with inside the super, the asset needs to be growing at the same time.
Yeah.
So if you can find something that does both, brilliant. But it depends on which stage you are. So for me, I would like an asset, for me personally, I'd like an asset where it can maintain itself. At the same time, I'd like an asset which can substantially grow, because I'm quite a while away from retiring.
Yep.
Although when I'm retired, I'm not really caring about growth too much. I want to have and live off the cash flow that asset provides. So at that stage, I might change my strategy to look at buying some assets where there is a very strong amount of yield, and that yield is obviously money that I can live from and retire quite comfortably. So your strategy will always change. It just depends where you are in terms of your working career, your investment strategy, and your financial circumstances. And that's why I personally like to utilize financial planners to really scrutinize myself, because I'm doing this on my own accord, and I don't know, if everything that I'm doing is 100% correct. So I like to be abused by financial planners sometimes, telling me that I'm wrong, or I need to consider something X, Y, Z, because then I can implement that into my strategy, and I evolve as my financial situation evolves as well. So there's an array of things that you obviously want to make sure that you're getting the combination just right.
Yeah, that makes sense.
For your time.
That makes sense. Now, we are proponents of buying properties which are cash flow positive or positively geared and in good growth locations, right? So that's there. But I want to ask about negative gearing, which is not something I usually ask about, because I'm not a big fan of negative gearing generally, right? I know it's got some benefits, but that's my perspective. On a personal level, if you're paying a lot of tax and, cool, there's the whole kind of tax argument for negative gearing. But if you buy an asset in your self-managed super fund that doesn't produce a high enough yield, can it negatively gear in there? How does that work? Or are you just going to end up with a shortfall that you need to make extra contributions towards?
Well, yes and no. So the super fund can have a negative geared asset, which does help reduce the tax the super fund pays on the contributions. However, the tax rate on super is 15%. So, to spend $1 and reduce the tax of the super fund by 15% really means that there's an 85-cent loss, which, yes, is factored in from the contributions that need to make up the difference. So we don't want to try to aim for a negative geared investment in super because the tax incentives aren't there. And then there's obviously limitations to your investment strategy. With a negative geared, say, for instance, property in super, you're really banking on just one aspect, which is capital growth.
Yeah.
To me, that's a big risk. That's my personal opinion for my personal investment strategy. It's a very big risk. I would like to have all bases covered, where if I'm not getting the capital growth I'm after, at least I'm getting the cash flow. Ideally, in both worlds, I'm getting both. But I would like to see, both sides of the pendulum growing. If not, then I don't want to just have one strategy completely pinned upon capital growth.
Yeah.
Paper wealth is not my personal investment.
No, I couldn't agree more. It's about having a healthy diet, a healthy balanced diet, I think. Yeah, for sure. So where do you see people going wrong with SMSFs then?
Look, I do see some people make the wrong decisions with SMSFs. They get too carried away too quickly. And, I see a couple of people, they'll buy, say an off the plan property in self-managed super, which is more of a lifestyle decision. And forgetting that it's not their asset, it's the super fund's asset. It's for the benefit of the members, for the benefit of their retirement. So I do see people make lifestyle decisions with their super as their investment strategy, and it goes horribly wrong in more cases than not. So I think that's one thing to look at. Your investment, your super, is not an investment for your lifestyle. It's an investment for retirement. So you really need to detach yourself and say the asset I'm buying is a number. It's not, sitting on a beautiful beach in a property that was owned by the super fund one day after a transfer is done at retirement phase. So you've got to really treat a self-managed super fund as a business, and a business always needs to be profitable, and that's what's a healthy business. Yeah,
interesting. And are there any other things that people need to know? Like if they're thinking, okay, cool, this makes sense, right? I want to super. I believe in property. I want to be I'm a property investor already. That makes sense to me. I want to do this. I want to get stuck into it. Let's say I've got a couple $100,000 in my super. Okay, this is sounding good. What other kind of things do people need to be thinking about or considering before they take that step? Or is there any other? Because I know, for example, you've got a higher deposit amount. For example, if you're going to go buy a property in your super, you've got your lower LVRs and higher deposit amounts typically in a self-managed super. Is there any other things that people should be thinking about?
Yeah, there's quite a number of things, and there's too many to mention, and I'm probably missed a couple. So what I'd probably say is I'll start with a couple of the basics that I think people need to consider, and these are the questions that I get, quite often. You can't construct in super with borrowing. So you can't go buy land and then you can't go to the bank and ask for a construction loan. Banks don't want you to take risks in super. So there's a concept called the SIS Act, and that's what we have to abide by as accountants and auditors and members of a self-managed super fund. So you can't borrow for construction. You can construct using the money that's cash inside the self-managed super fund, but you can't go to the bank and ask for a borrowing for construction. And that's a granny flat. You can't borrow for construction of a granny flat. You can't borrow for construction to do a huge renovation. So there are some limitations from a borrowing side of things.
But you can still get the benefit from those things, right? So if you've got enough cash surplus in your SMSF and you want to do that kind of thing, then you can still get the benefit from it. So let's just say, for example, right, you bought a battle axe subdividable property, right, in your self-managed super fund, and there was enough cash left over to be able to do the subdivision and build a second house on the back, right? You wouldn't be able to get any debt to complete any of that. So there's an argument to say that they might not make a loss. But at the end of the day, then you're going to end up with the asset, right? Can you then, and this might be treading into broker territory and stuff like that, so maybe just your opinion is fine, but like, let's say you've got some leverage on the first property that you bought, then you've added cash, you've now got two assets, you've added a heap of value. Can you then go and leverage all of that and then kind of go again? So you can still get the net value out of it in the end.
Good question. So the second then is that you can't extract equity from yourself. You can't extract equity. You can't extract equity. So part of the SIS Act and the way that the banks are protecting under a limited recourse borrowing arrangement is that you're unable to extract equity from a self-managed super fund purchase.
Hang on a second. Does that mean like if it stays inside the SMSF, right? So let's just say you buy one house, forget about the subdivision scenario, right?
Mm-hmm.
Let's say you buy a house for 500 grand and then a few years later it's worth $1 million. So you got $500,000 of equity in it.
Yep.
In that SMSF, can you refinance that property, take the equity out and buy another property in that SMSF? Or is it, we'll start there. Is that right?
Yeah, no. So you can't extract equity. So you can refinance between different banks, dollar for dollar. But you can't extract equity from a self-managed super fund property. So the loan, in effect, will never grow. And that's, again, to really protect the member of the super fund so that potentially there can't be an overcapitalized asset. So that's one of the restrictions in there. So if you do want to capitalize, and I've seen some clients do it very, very, very well. They'll start with one property. That property will double in, say, 6 or 7 years. They'll sell that. They'll then buy 2 properties. Those properties will double in 6 to 7 years, and then they'll buy 3 properties or 4 properties. And they're doing that by having to buy and sell.
Yeah, okay. So the only way to access the equity in those properties is by selling the asset, liquidating the asset.
Correct. So it's a very safe. Remember, what the government, what APRA, what the banks, what the SIS Act is trying to create is a very safe way for you to invest and not lose your money, because there's obviously lots of risk when you go into the bank, you extract equity, you then use that equity to go buy another property. Property prices come down by 20%. All of a sudden, you've got 100% geared property. So what the banks are trying to do, and that's why they really try to get you to go in with a larger deposit, is to protect their investment, which is their loan, but also in pseudo to protect yourself as a member of a geared super fund. So I always tell people, super funds, keep it very kosher, keep it very neat, keep it very basic and simple. The moment you try to start to get too creative with it, you'll find that there is too many levers. You've got to make sure you pull in at one time.
Yeah.
And there will be that one lever you miss, and potentially the whole thing comes crashing down. So I'm a big fan of really getting some good quality assets from the start. And if you do want to liquidate those assets and capitalize on the profit you've made to then buy 2, well, then that potentially, based on that person's strategy, might be a good way to continue to build wealth in their super. So that's a little bit of the reasons as to why we say to clients, before you start looking at a self-managed super fund, make sure you've kind of hit all your goals, or you've hit your limits outside super, because you can get creative with, investments outside super, which is extracting equity and going again and borrowing for construction, where in super things are very tightly held. There's a lot of regulations around it.
Yeah, so that's an interesting perspective. So do you think people should, do you think if let's say you're in a position where you can do both, right? You've got your personal strategy and you've got enough in super and you could do both. Is there any reason that you wouldn't just do both at the same time? Or, because you kind of said there, maybe max out what you're doing in your personal life and then look at it. But is there any reason that you wouldn't sort of go both?
No, you can do both at the same time. I've done both at the same time. But, I think that's how many plates of food can you eat at once?
Yeah,
right?
How many things do you want to juggle all at the same time?
That's right. So it's and age is a big factor.
Yeah.
And also the capital that you have in the super fund's a big factor as well. You don't want to. I think sometimes you don't want to prematurely rush into something. If there's an avenue where you can wait, build up your skills, or build up your exposure, then it gives you just a better position to make the right decision moving forward. That's what I generally say for myself. But at the same side of the argument, no, there's no reason as to why you can't do both or one specifically. It really comes back down to that person, their individual goals, their investment strategy, and their financial circumstances.
Makes sense. So what about the operating costs of self-managed super funds? As a general guide, right? As a general kind of guide or a rule of thumb, like how much does it cost to set up an SMSF? How much does it cost to operate an SMSF? Because I know that that can have an impact for some people as well.
Yeah, costs may vary, depending on what people want out of their self-managed super fund. But I think if you're establishing a self-managed super fund, you've got to make an allowance of anywhere between, say, 3, 6, 7, or 8 grand, depending on the type of strategy that you want to take.
Yeah.
Financial planners will be involved, accountants or solicitors will be involved. So there's a number of people which are there to help you establish it and make sure that you are doing the right thing.
Mm-hmm.
So for me personally, when a client comes to me saying, I want to establish an SMSF, well, I'll create a number of roadblocks to make sure that they're going to the right people to get the right answers. So I'll make sure that they can actually borrow in their self-managed super fund if they're wanting to buy a property. So go chat with the broker first. Make sure that you've got enough contributions and capital to actually facilitate the purchase you're wanting to make. Because if you've got 200,000 in super, but you want to buy a $10 million property, well, straight away the broker will tell you it can't happen.
Yeah.
Then I'll send clients to a financial planner to get a statement of advice, and that financial planner will run through, how their existing super fund is going. Their proposed self-managed super fund. Are they aware that they might be getting a 7, 8, 9, 10% return in industry, or they might be getting a 3% return in industry? Do they believe they've got the skills or the people around them to beat that? The time involved with a self-managed super fund, the type of assets they can invest in. So I'll send them to someone so they're getting a really good combination of skills and knowledge. And then from myself, once I've seen, a number of ticks, then we can look at establishing the SMSF, and I'll work out, well, what type of investments do they want to be buying? And then obviously tailor the structure for them so they can complete their investment strategy. Ongoing costs, look, that again varies depending on the complexity of the self-managed super fund. I've got clients where there's multiple properties and hundreds of thousands of dollars worth of shares, and it could be hundreds or thousands of transactions. So you might find the cost of that is much higher compared to someone just buying one property. But I would probably say on average that people need to make an allowance of anywhere between 2.5 as a low end, all the way up to 5 or 6 as a medium end, depending on what they're doing.
Number of properties, complexity, personal situation. Yeah, that's a good general guide.
Super funds much higher than that when they start to enter into pension phase or various different investments. So, I think if you can make an allowance of about 1.8 to 2 or 2.2% as an admin fee of running your super fund based on your balance, I think that's healthy as a bit of a provision.
Yeah, that's a good general rule of thumb. And that's kind of all I was after, like a general rule of thumb, like 1.8 to 2% as a kind of operating expense to kind of keep the wheels turning. That's a good guide. I know you said you've got a list that's way too long to possibly list everything else, but touching on the construction one there was pretty good. That was a bit of an eye opener. What have you got any other nuggets that we can drop in there?
Yeah, so lots of people ask, well, what else can I invest in? Can I invest in artwork? Can I invest in gold? Can I invest in silver? Sorry, my apologies, mate. Yes, the answer is you can, as long as it's for the benefit of the member at their retirement. Then the answer is yes, you can invest in those things. I've had some wild ones saying, can I invest in antique cars? Well, if you deem that antique car and you've spoken to a planner and there's a statement of advice around it and you think it's a good investment, then yes, you can. But you can't get the use of it today as a member. It's always for the retirement of the individual member. So, you can't buy that painting and hang it up in your home. You can't buy that antique car and drive it around on the weekend. You can't buy that house, on the beach as an investment and just use it on the weekend. It always must be for the benefit of the member.
Okay, so that's pretty interesting, right? That's an interesting quirk, right? Because like in theory, right, you've got the SMSF, which is its own independent business and company, right? And let's just say you went and bought a home, right? A house. Could be a holiday home, could be a whatever. And then you decided that you wanted to be a tenant of that, right? Could you technically do that as long as you were paying, so let's just say it was let's just say you bought an apartment in Sydney, right? Just for argument's sake, right? The SMSF has bought the apartment, but then you as an individual wanted to become the tenant of it and you potentially paid rent back to the SMSF.
Yep.
Can you do that?
I like to play with a straight bat, and the answer is no. It's still obtaining a benefit for the member.
Got it.
Now, could that member have bought that property in their own accord? Probably the answer is no. So the super fund buying that property and they paying rent to the super fund, they're obtaining a benefit because they're living in a property that, otherwise they wanted to live in themselves. So I like to pay straight bat, and the straight bat is that, super fund is not there to help yourself today, not there to help your family members. It's there for the benefit of the member for retirement. So no, you can't be buying that holiday home and you renting it out yourself personally. External third party, an auditor will want to look into it and make sure that, is this really for the benefit of the member for their retirement? I use that word all the time because I'm really trying to reiterate to anyone listening that, you don't get funky or crazy or silly in super fund. You play with a straight bat as much as you can.
Yeah, it's a heavily regulated kind of, part of the whole kind of financial ecosystem, and for good reason too. Like, I think,
100%,
I support it. So no, I don't, certainly not encouraging anyone to go and try and find all the cracks and crevices, but it is interesting.
There's
interesting
lots.
thing. Yeah.
Mate, there's lots. There's a list of things you can't do. And again, the constant communication you'll have with your accountant and your advisor, they'll make sure that you are heading in the right direction. I just think the main thing that people need to focus on when they are, and if they are looking to do a self-managed super fund, is pick a good investment. This is for your retirement.
Yeah.
This is for you to enjoy the better things in life as you start to age. And you want to give it the best crack. You want to have the best investment in there. And you want to make sure that you're getting the best returns as your strategy for investment changes over time.
Yeah, 100%. And remind me, what's the minimum age that people can tap into their SMSF?
So there's obviously, I've seen members who are below the age of 18 into a self-managed super fund. That needs to be obviously with a guardian. But generally speaking, there's no minimum age essentially, as long as you're working, contributing to it, then you're fine on that level.
Yeah.
You can have a super fund at the age of 15, 16 as
yeah.
when you work a little part-time job and you earn over the certain amount of money for the statutory contribution, you start contributing to super. But I think it comes more to a minimum balance based on your investment strategy more than a minimum age.
Yeah, got it. And what's the minimum retirement age so that you can actually start to, like, if you buy that holiday home now, but you can't live in it, when are you going to be able to start getting the benefit as a member?
So as a member for retirement, that is changing all the time. It's kind of like a rolling graph, but 65 is when you're born at a certain date, 66 and a half, 67 and a half, 68.
Yeah.
I'm sure it will change and we'll be working to a 70 before we can tap into it. Now, at the same time, if you are, wanting to buy a home and you're wanting to one day get it transferred to yourself from the super fund, it's not that you can live in the super fund asset at that time when you're retired. There's a certain strategy to getting the property out of super and into your own name.
Ah, interesting.
Yeah, because remember, the whole purpose of the super fund always is to benefit the members.
Yeah.
Is to benefit the members.
Not just benefit them as a place to live. But
That's right. That's right.
Yeah. Okay. Awesome. And who's the best person to set up an SMSF? You've mentioned, speaking of financial planner and stuff like that, is it someone like you, Jeremy? Is it an accountant who sets it up?
Generally, accountants will set it up. We've got a very streamlined process of the way of doing it. Financial planners do set it up as well. I've seen them charge a bit more of a premium compared to what we do, because we're the ones who do all the applications with the tax office and the ABR. But generally, accountants and solicitors, they're the people that do set it up. And it's just making sure that you're getting a person or a professional who knows what they're setting up in lieu of what you're aiming to achieve. I've seen many people set up self-managed super funds and go to buy a property, and all of a sudden they haven't got the right structure to buy a property with the custodian entity being in place. So you want to go to someone who's been there, done that, track record, and can kind of get you going straight away from the start.
Awesome. Love it. And so if someone has listened to this and they're going, yeah, okay, sounds good, I'm into it, and they want to set up an SMSF and they want to reach out to you, how do they do that?
They can reach out to us on our website, ktripartners.com.au, or they can get in contact with yourself, Goose. And, we help many mutual clients, making sure that they're all doing the right thing. So there's either avenue, mate.
Yeah, absolutely. Sounds good. Mate, I've really enjoyed this conversation. It's been eye-opening. I've learned a couple of things out of this as well, which is good. And I'm sure it's been beneficial to the listener. Mate, anything else you want to add before we wrap it up?
No, mate, it's fantastic. I think for many people out there, especially coming back to the economic discussion that you and I are having, is that, don't be too worried about interest rates as they are at the moment. All you've got to do is maintain your buffers. You've got your stress tests in there as well. When the banks do service you, they do service you on a bit of a higher rate. So in life, if we've got an extra cost on the left with something maybe that we have to streamline on the right, it's always about balancing the budget. That's what the government's been trying to do for many years without any success.
Yeah.
But us as individuals, we're a much smaller entity. So it does become easier to balance the budget when we're in tune with our income and our expenses. There will be opportunity out there, 100%. I know I'll be looking into the market very closely over the next 6 and 12 months, because I think there'll be a great opportunity for me to buy. I've parked some money on the sidelines in anticipation for this. So where, someone might not have the kahunas to hold during a little bit more of a volatile time, I think if you fundamentally assess the property and you think that it's got a good longevity in it, then it might be a good opportunity to look to purchase.
Perfect. Couldn't agree more, mate. Always enjoy our chats. Really appreciate it. Look forward to seeing you on the show again.
Thanks, Goose. Take care, mate.